great to have with us Stephen Poloz, former Bank of Canada Governor and Senior Advisor, Special Advisor to Ozer, Hoskin Harcourt. Great to have you with us, Stephen. Appreciate your time.
Thanks, Amanda. Good to be here.
So I do want to start with your kind of current thinking on where we are, how healthy the economy is, how it's holding up under the various stresses.
Well, I think it is important to remember that we started all this with the economy in the best shape it had been for a long time. Unemployment at a 40-year low and inflation right on target. And that's the best place you could be for a shock like this to hit the economy. Since then, what we've seen is plenty of evidence that the economy is quite resilient. I think of it as the shape of a K, which lots of people are using that nomenclature. But basically, the economy went down and it came back, and the top part of the K was a very rapid recovery and very solid. In fact, retail sales are above where they were in February. But if you look at the bottom part of the K, of course, we have all the damaged sectors. And these sectors are probably going to be in the bottom part of the K for a long time. In the meantime, we're probably going to trace a W and go through that cycle again. But I think it's going to show again that inner resilience, buttressed, of course, by well-targeted government policies. And, of course, that period where the banks were letting people take holidays on their mortgages was very helpful.
This K-shaped, both the effect on people and then therefore the recovery, does widen disparities that you've talked about for years. We're aware of them. We know that they exist. The pandemic really exacerbated them. Do you think Canada is in a better position because of some of our structural welfare state supports in place, that we actually offer better support for the bottom part of the K, or is it job number one to figure out how to help that group of the population?
Well, I think the data show quite clearly that Canada's distribution of income measured by Gini coefficients or any of the other measures is one of the best, if you consider equal best, and in the OECD area, not quite as distributive as we see, say, in the Nordic countries, but otherwise right up there. And far, far more redistributive than in the United States, where it's actually gone the other direction in recent years. And I think this is very important to both the resilience and the nature of the recovery that we'll see. And so, in addition, the fiscal arrangements that were put in place here in Canada were very automatic in nature, or what we said elastic at the time. That if we have a second wave, the effects are, say, they're as big or not as big, whatever they are, the automatic programs that were put in place will be the shock absorber. Whereas in the United States, you have to take another package to Congress and renegotiate it and see if we can get checks out by such and such a time. Those two aspects, I think, are helping quite a bit for our recovery.
We do have, along with those automatic stabilizers, Stephen, a ton of new support that was put in place, much of it designed in that a kind of emergency fashion. You were right there through this whole process. And the feeling was we just got to bridge over a terrible time when businesses have to stop operating. And then on the other side of it, the economy will kind of gather its legs under it. The problem, of course, is the bridge is longer than we thought. It's going on longer than we thought. How much do you think, when we take away those supports and we hope the underlying economy is going to pick up and catch everybody, how much do you think will just collapse? People that have been hanging on through this, taking the support, but don't actually have anything left in their tank to keep going on the other side of this pandemic?
Well, you're absolutely right. The bridge is proving to be much longer than what we had visualized back last March or April. And the difference between a liquidity problem and a solvency problem is just time. And so a lot of companies, small companies especially, are at the end of their ropes. And so there's definitely going to be damage and scarring in the economy, both the companies and the workers associated with them. There's absolutely no two ways about that. How bad is that? Well, the bottom part of the K at the moment is something like 3% of the economy. The economy is operating at about 97% of where it was last February, give or take a few tenths. And so I think we've got at least a good prospect of having a good base there. And the consumer is well armed, having been well supported through this will have boosted their savings quite a lot, and at the same time actually spending more, 7% more than they were a year ago. And so we have a very lively consumer with pent-up demand. I mean, the pent-up demand, it only goes so far when it's services, right? You can't go out and go to the same restaurant 3 times in one night to catch up. You're never going to catch up. And so there is a permanent loss of demand for some of these damaged businesses. And it's hard to say how the survival will look like, but I will say this, that it's, especially restaurants, bars, and so on, these are high turnover sectors always. So they're usually a more adaptable kind of sector than the typical sector.
One thing that does seem clear is that Ottawa is already focused, and we'll likely see some details around this in March, on spending in a stimulative way. Now, we heard this in the speech from the throne, and we should be cautious because a lot has changed since then. Then there was just the beginnings of our second wave apparent, and it changed the tone, I think. But there's still this sense that there will be up to 3.5% of GDP spent on stimulating growth. How should that be spent? And I'm sure they are asking you, they should be. What's the best way to do that for our economy?
So I think appropriately the government is thinking of this not in the usual way that we think of fiscal policy. Fiscal policy is normally thought of as filling a gap, a demand supply gap. It's usually not expected to be really long. So it's called stabilization policies. Actually, from what we've heard, it sounds like they're focusing a lot more on what we'd call structural policies or investments, truly investments. The first thing you think of is infrastructure. For example, you do a big piece of infrastructure and it serves us for 30, 40, or 50 years, and it adds to the productivity of the economy. So anything that comes along that can tilt upwards the long-term growth trend in the economy will be really timely at this stage. Those things were always true. We always use better growth, but the thing is here, I think some of the barriers, let's say the political barriers to getting structural things done, could be less because everybody's involved and everybody wants us to get through to the other side. And particularly, they want to have the ability to service the debt that's being created at this stage. And it's through economic growth, just like after World War II, that will service that debt.
And so let's talk about the debt and start with the deficits. We know, we've been told by you and by your successor and by many others that we shouldn't worry about it. The cost of borrowing is low. Many are worried, though, about how long it might take to get back to balanced budgets. And then, a nice idea is actually paying down debt instead of constantly borrowing. What's your thought about what that trajectory should look like?
Well, I think going back to your previous question, it's about the conditions for sustainability of a government debt position are pretty simple. It is that the rate of growth in the economy needs to exceed the rate of interest the government must pay on the debt. And provided it does so, the stock of debt will shrink as a share of the economy while they service the debt. And today, debt service is quite inexpensive, as you know well. And just for a point of reference, compared to the mid-1990s when we had almost a fiscal crisis, debt service payments are about 1/5 of what they were back then. So we have room for interest rates to rise and have just normal growth in our economy and still have a good sustainability situation. But the key is to make those investments that will tilt the line up, things like daycare. Daycare would boost the female participation in the workforce and give us more trend economic growth, or eliminating interprovincial trade barriers. The IMF estimates that could add quite a lot to our GDP year after year after year. That's the kind of free money we need to be able to pay this debt down. But just ask somebody my age, if you remember growing up during the 50s and 60s, if people were talking about the debt was left behind after World War II. And the answer is nobody was. I never heard talk about that at our kitchen table. It was because we were growing fast enough that it basically disappeared in the rearview mirror.